All right, everybody. Well, welcome to the Cedar Harvest Show. Today, we're excited to talk about the PEM model. We're going to visually show you what your finances look like. Let's put all the variables of your life into something you can visually see. Is your money going to run out? Do you have enough? Are you hemorrhaging money in buckets you have no idea about? Well, guess what? Our financial expert, Todd Desberg, CFF of over 25 years, a fiduciary, is going to show you what he does, the tools he uses, and he's going to blend that with Officer Ty and show exactly how this works with a pension and what you should be looking out for. Enjoy. All right, everybody. Well, welcome to another edition of the Cedar Harvest Show, where we focus on financial education for a variety of things that affect not only your life, but also your spouse, children, charities, and your legacy. We discuss everything from health insurance to pensions, wills and trusts, to best ways for everyday tax planning. Our intention is to bring financial and legal professionals together with everyday people who need their help. We have real conversations with real people who have real life questions and scenarios. I'm your host, Mario Lizarraga, and today's show is part of the law enforcement series. So I'm happy to have our co-host, Officer Ty, welcome, who's an 18-year law enforcement veteran. Hopefully, 18 year? Is that accurate?
18 years, yep.
All right. Employed here in Arizona. So welcome. Also happy to introduce our special guest and financial expert of 20 plus years, Todd Desberg. Welcome, Todd. How are you, buddy?
Great. Thanks for having me.
I'm excited to have you on here, and I'm definitely excited to get you two to meet each other and open up a lot of financial conversations. Tyler and I have been talking about a lot of different things for a long time. And one of the things that we've always been kind of stumped on throughout our conversations is having somebody like yourself, Todd, to disseminate correct, accurate financial information. So we appreciate you being on here to educate us on all things financial. And maybe if you want to start here, Todd, why don't we just kick off? Tell us a little bit about yourself and who you are and what you've been doing all these years.
Sure. Of course. Well, actually, I'm proud to say I'm going on 25 years now, Mario, since I've gotten into this business and working with clients, families, business owners, and helping them. First of all, Officer Ty, thanks for your 18 years of service with Phoenix PD. I know you work hard for your money. Your money should be working hard for you. That's what we want to help you with today. When people think of financial advisors, they usually think of one or two things. Couple of different ways we can help our clients. One is we can help you find better products that earn a greater rate of return and maybe even a lower cost or reduced fees. And the other way, and this is what makes my practice unique and different from most advisors, is we find it's much more valuable to help our clients avoid the losses. And by finding money that they're losing unnecessarily or unknowingly, we can then bring that back to the table and help them fortify their financial future. And so it's a much greater value in working with our clients over 25 years. I've seen over time, these small changes in avoiding these wealth transfers is what we call them, can make a big difference in your financial future. And so that's really our core philosophy. There's more opportunity in helping you avoid the losses than just picking winners. And so, I don't know, how does that sound to you, Tyler? Is that something that?
Yeah.
And, it's, and I've heard you talk about this, Todd, because I've worked with other clients outside of obviously the law enforcement spectrum. And I know you've told me that you've worked with a lot of different, some of your clients are from the law enforcement background, retired police officers and whatnot. So, before we get into it, really deep dive into what you do, Todd, if you don't mind, let's just kind of pull back and Officer Ty here, tell us a little bit about what, help us understand how it unfolds there for you within the state of Arizona and what they offer you and guidance and support. Do you mind kind of summarizing that?
So we get, it varies by department, but we get kind of a little rundown at the beginning when you get hired, but it's not really that in depth. It's just kind of, hey, these are your options. These are kind of the products we offer. And then it's really on the officer or whoever it is to kind of go deeper into it. So if they really, you can either just leave it alone, like from my standpoint, I did that for most of my career. I just kind of, the stuff they put me in at the beginning, I just stayed with that. They were like, hey, put this amount in. This is kind of what you'll get.
Aren't you forced to? I mean, your pension, you have like an automated, there's no option there, right? You're like, you have to pay into that.
Yeah.
Is that accurate?
Yes, that's accurate. And then there's the set amount that the city will put in for there too. But then, like I said, it's up to you. Like other products or other things you might want to do, that's kind of on you. Like if you want to use somebody else other than who is basically recommended to you at the beginning, that's on you to. They don't seek. They'll come and present to you, like, hey, this is what we offer, but it's really up to you to, seek it out and find something else.
Figure it out.
Yeah, pretty much.
And then so that's pertaining to your pension. Well, no, the pension's already taken care of. You're not in control of how your pension dollars are invested. You have a little more flexibility within the additional retirement components, correct?
Yeah.
And
we have a deferred comp. That's another one. You can either put $5 in it, or you can put up to I think it's like $600. Actually, it's different now. When I started, it was like, I think the max you could put in it was like $630 a paycheck, something like that. And I don't remember exactly. Some guys would max it out, and we're maxing it out from the very beginning, and other guys were not. Like myself, I didn't take advantage of that in the beginning, which I kind of kicked myself for. Like looking back, like I didn't fully max it out like I could have in the beginning, which, it is what it is.
Yep. Todd, are you still there? Can we still hear you okay?
Yeah.
All of a sudden, we lost a lot of background fuzz, which is fantastic. I don't know if you clicked something on your end.
I can hear you perfectly.
Way better now.
It sounds way better.
Whatever was going on. Yeah, that's clean and less distracting. So thank you for that.
Great.
So the way that, just to catch you up here, Todd, the way that, Tyler and I started talking about in the financial spectrum, kind of came to some questions. I found out I did some things with pertaining to life insurance and my girls. And then he had questions about that. And we started, so it just opened up the financial conversation about how does permanent life insurance fit in? I was intrigued, being I'm a finance major, and I've always been intrigued with money and financial stuff. I'm by no means a financial advisor. I do handle permanent life insurance for a lot of my clients, but typically work with a lot of business owners. Typically, they don't have a lot of equity accounts until later on in life when they've sold the business and they're investing. But they're typically dumping, like me, I'm dumping money back into my business. I am my equity. So for me, talking to somebody like Officer Ty here, who has pensions and these other drop programs that he's referring to, it was very obvious to me there was a limit to how much I could even talk to him. So that's why I think it's so fantastic to bring you involved and get you in the middle here, Todd, because really they're focusing more. They need more information from you by far.
Yeah.
Just
in general. Yeah.
Right. So thanks for being here again, and so. Let's just jump in.
Well, that's a great point, Mario, that you mentioned just there, that you have a team surrounding you, Officer Ty. You've got a specialist at your workplace. You've got a specialist to help you with Mario in certain aspects of protection. And then, I used to be that guy sitting in your break room signing employees up for the 401k, 457 plan, the pension. For many, many years, I built my practice doing that. But the reason I became a certified financial fiduciary is so that I could do just what you're talking about. When you're considering your overall financial picture, the 401k or the 457 plan at your work, or a 403b if you're employed for a nonprofit organization, that's just one piece. And what I found is that a lot of people really didn't understand how those plans work and how, it affects every other aspect of your financial plan. It's kind of interesting, when you look at, how these things affect, I work with a lot of dentists, and, they'll talk about how, your oral health affects your whole body. And so it's the same way with your 401k. If you're doing something in your 457 plan or your qualified plan at work, we really need to consider how this is going to affect you 10, 20, or 30 years from now when you're spending that money and enjoying it in retirement. Consider taxation and a lot of different things that are worth considering while you're young. So I commend you for getting started on the plan. I don't think it's a bad thing necessarily that you didn't max it out right away. You met somebody like Mario, you've been doing other things. But let me ask you a couple questions and see if maybe this is what you're looking for as far as exploring other aspects of your financial planning, spectrum that's out there. And so what most people want to know, and I don't know if your investment advisor answered this question for you, but how much really do you need to be saving in order to have enough set aside in retirement to then, when you turn on the income, adjusted for inflation, be able to maintain your lifestyle the same way that you're living today? Do you know what that number is?
No, I don't. And I mean, I can't say that it's a hard no that they never talked about it, but I don't remember. And I don't know the number.
Would you like to know?
I would like to know, yes.
Okay, well, we can answer that question and the three other main questions I'll go through here with you in about 15 minutes. So what I'll do, Officer Ty, when we finish our conversation today, I'm going to send you a link to my personal, private, confidential portal, and you can plug in some of your information, what you saved, how much is in there, and then we'll be able to then do a complete analysis, look at everything comprehensively, and be able to specifically tell you, this is what you need to be setting aside every month or every year. The other thing people want to know is, how much do I need to be earning on my investments? Is it 4%? Is it 10%? What's the number? What's the target rate of return? Have you ever considered that, or anyone ever talked about that?
Up until this point, I've started to think about it more, but I still don't. I'm not knowledgeable enough to really know an answer to that. But like I said prior, I didn't really look into any of this stuff. So
fair enough. But you'd like to know.
Yeah, I would like to know. Yeah.
Yeah. Okay. How about this question? People always ask me, right away, especially when they're getting a little bit older and they've been working a long time, is when can I retire? What is my target retirement date? How long do I need to work in order to be able to, again, maintain my lifestyle after my income goes away, adjusted for inflation, so you don't have to worry about ever running out of money? Do you have a number in mind, or that you have
Technically, I can retire November 2026, but I know I was kind of looking at the numbers, I think it was a couple days ago, and it's not the greatest. And at 20, I think it's like 65, whatever it is, 62 and a half or whatever the percentage is that we get for that. So, it's something, but I'll still be young enough where I'm likely going to keep working. I'm not going to stop working. So,
well, and it's interesting that what I hear being around a lot of other, I have a lot of law enforcement in my family, and it seems like the question is always like, do I retire from this and then go work for another agency and try to double dip? Do I work longer? I've heard you talk about, am I going to stop at 20? Am I going to go to 25? Knowing that you guys get a little bit more. I was just with my cousin this weekend. He already has 25 years in, and he said he's going to try to go another 10. And I thought that was very surprising after I've had conversations with you and then other officers who were like, that's crazy. Why would you go that far under one department? I think I told you before, some people haven't done this kind of stuff. They haven't planned, so they kind of have to work, and they work longer than they, I think I kind of told you the story on one of the other ones. Like, I know a guy who's getting ready to retire, and he never maxed out anything. He never really worked overtime, so his pension will be something, but it's not, and he's older too, so he's probably going to have to work. He's probably going to have to get another job. It's not, likely not going to cover his lifestyle. Yeah. He's going to have to adjust something.
Because he's leaving, when he worked before, we're making good money now, but that wasn't the case before, and he wasn't really ever maxing anything out. So
right. Yeah. And that pension that percentage of your salary that comes in, that's just a set rate based off of your salary, correct? Yeah. Whatever that is, 13% or 11% or something like that.
And I think the numbers that they put on the retirement site they're not accounting for taxes and
the dirty word.
Yeah, your cost of living increases too. I don't think it takes that into effect. So this is the number you're going to get.
No COLA, no inflation. You're stuck.
I don't think so.
But. Right. Well, and I think answering that, doing this analysis will help you answer that question and get some real clarity on what that actual date is where you could turn off the income. Because the last thing is, and you just touched on it, if you don't do anything differently and just continue doing what you're doing today, well, how much would you actually need to reduce your lifestyle in retirement so that you didn't have to worry about running out of money? And so that's another calculation. Of course, we don't want our clients to reduce their lifestyle. If anything, we want to see an increased lifestyle, but at the very minimum, we need to make sure that our clients can maintain their standard of living adjusted for inflation so that they can have that asset throughout life expectancy. And so those are the things that we'll quantify as a fiduciary. I can do that for my clients. And that's really what makes us unique and different from most advisors. I've got this model. I'd love to introduce you to it, show you, and maybe we can get more into it because I want to introduce you to this, what we call the personal economic model. And this is, have you ever seen this before, or does it remind you of anything or look like anything?
Yeah.
Okay.
You've seen it.
What do you think of when you see something like this?
You showed it to me one time when you were showing me like what this kind of looks like.
Yep.
Okay.
So let me just walk you through it and just kind of do a refresher, because I think what we see most advisors focus in on is this risk tank right here. And actually, I'm just going to back up here real quick and just show you this.
This is an amazing tool. It's very visual. I love it.
Yeah.
I've seen other tools that are out there, and it's just, this is way more user friendly I believe.
Thanks for pointing that out. I just want to make this user friendly for our presentation and for time today, so that I can advance this and just walk you through how the model actually works. So this big tank on the left, this is your lifetime capital potential tank. The reason it's so big is, let's face it, over your lifetime, you're going to make a ton of money. There's going to be a lot of money flowing through that tank. And that's why it's represented in this kind of a size. Now, it obviously doesn't fill up all at once. It's going to come through with your paycheck every 2 weeks or every month, however you're getting your compensation. But you see, the first thing it hits here is this tax filter. Now, unfortunately, the government bolted one of these on everyone's model. Everyone's model looks the same. This is the first thing that it hits. You got to pay your state and your federal taxes. But after that, everything that you receive is what goes to sustain your current lifestyle, pays all your expenses, all the protection aspects, your home, your car, any education, your kids, food, clothes, entertainment, all those things. Once that money's spent, it's gone forever. We know, and we like to remind our clients, this is not an infinite resource. This is a finite resource that really deserves to be cared for and managed carefully, every penny that comes through here. So what we know is that a responsible person like you, when I asked Mario to introduce me to somebody who he thought we could help, you were the first one that came up, because you have the sense to manage your current lifestyle and do what we consider pumping this extra cash flow in an upward motion, which we know requires a conscious effort and a lot of energy. So you've dialed this in, whatever your exact cash flow requirement is for your current lifestyle, and you were able to push, whether it was 20 or 25% up into your future lifestyle. And then you have this decision to make. And this is maybe what you talk to your investment advisor in the break room about when you're signing up for the 401k plan. You have money going through here, the qualified plan contribution, into this risk tank. Or you could put it into a safe tank. You notice on the safe tank, it's got a lid on it. Well, the reason this investment tank over here doesn't have a lid on it is we know, we can grow this money, but it's invested in different assets. And we know that there's volatility in the stock market, and we can have what we consider evaporation out of this tank. And we've seen it happen before. And so it's always important to create a balance for our clients so that they have enough in this safe tank so that we're able to get them into what we call position A. And that is, they have enough money in these two tanks so that when they do retire and they decide to drain those assets, they don't ever have to worry about running out of money before the end of their lifetime. And so that's what we call our position A. And now I realize you have other assets here, and it could be represented in this tank here with your home, Maybe you have a mortgage. I can, show you that here if you have any borrowed funds. But I just want to focus on one thing here. Again, as a CFF, becoming a fiduciary, this is a very specialized field because most of my colleagues will only talk to you about this risk tank over here. Hey, what do you have, Tyler? Oh, we got better product. We can earn higher rates of return for you. Give us your money. We'll manage it. We'll charge you a fee. That's pretty much how every conversation goes with most of the advisors in the industry. And there's nothing wrong with that. That's an important function that they serve. But what we do as fiduciaries is we also focus on that. We know that this is important, and we're independent financial advisors, so we take great care in doing that. But the other thing that I think is just as important, as I pointed out with our core philosophy, is making sure that our clients aren't unnecessarily losing money or unknowingly having this wealth transfer occur. If that's happening, whether it's with your tax situation, whether it's an investment strategy, whether it's the way you're paying for a large capital purchase or your kid's college education, we'll point that out. And we'll make sure that, hey, if it's unknowing, let's make you aware of it. And if it's unnecessary, well, let's stop it or at least reduce it over time. These small changes, again, can make a huge effect on your overall financial picture when we get to the retirement age. So let me just pause for a second. Do you have any questions about the model or how this works?
No, I don't think so. At least not yet. No.
I do, if you don't mind.
Yeah, please go ahead, Mario.
So how customizable is this to someone's plan? I mean, I like the simplicity of what I'm seeing, but obviously life isn't that simple. So, I mean, these fairly customizable, or what kind of inputs are you putting in here? For
great
these
question. Thanks. So when I send you that questionnaire, Tyler, what this model is actually going to do is allow me to test all of these scenarios, all the different options and alternative strategies that we could consider for you. And then we can compare them side by side in this model, showing you, here's what you're currently doing, here's how this will affect you over time, and then show you a side-by-side picture of the new strategy and the improvements that we could make over time. So very customizable to answer your question, Mario. In fact, I could show you a little snapshot of one that we've done for another client, that you can actually then see the layers of all the different accounts inside these investments. So it'll be quite detailed. We'll show your actual home account value, how much you have in these different accounts in the safe tank, how much you have over here. And then the beauty of this is then we can, under certain assumptions, we can then fast forward these year by year throughout your lifetime to test these strategies and see how the model will react. This way we can find the most optimal strategy for you, what's the most efficient and effective way to get to your goal, and make those recommendations and take action. So that's why we have this process in place. It's this 10-step process that I alluded to at the beginning. But that's, if you want, Mario, I could definitely show you a quick example of what one of those models look like.
Yeah, I think that'd be helpful just to kind of, just to see a quick, like, what do you do?
Yeah, of course.
If you have a sample scenario.
Yeah, so what I'm going to do is I'm going to stop that because I got client names here. So let me just pick up a generic one that I could share.
I wouldn't mess up your presentation, buddy.
No, not at all.
I'm good at throwing curveballs.
I love it. No, this is exactly, what I like to show my clients. And this is what, you can expect is this is a living, breathing thing.
Just so you know, we can no longer see your screen.
Yep. I'm going to share this with you. Yeah. So now you should be able to see this now. Okay. And I'm just going to scale up my tank so you can see, everything that's in there.
So this is an actual scenario of John Doe.
Right. So now you can see the home, he's got $1 million home. He's got a little bit of a mortgage. He's got some cash value built up here in his safe tank with some permanent life insurance. And then over here in the risk tank is a Roth IRA, retirement accounts, an IRA rollover. And there's another asset down here, a brokerage account. And so we can get into this. You're going to probably ask me, well, what's that red slice of the pie here? I want to talk to you about that, but let me answer Mario's question here first, because, what's going to happen with this client? He's got some earned income. He's got some protection benefits in place if he should get sick or have a chronic, a critical, or even a terminal illness. If this goes away, we've got protections so that, life insurance, Mario, you brought it up earlier. It's of all the financial products that exist, life insurance is the only financial product that can guarantee what you want to happen will happen, even if you're not here to see it. And so, with life insurance, if this were to go away, it would immediately fill up these two tanks. So, I'm glad you have somebody who's already talked to you about that. But you may want to say, how's this going to react over time? And what I simply will do is I can either click the step feature here and it'll advance it 1 year at a time, or I could just slowly advance this 1 year at a time by clicking the age button. And we can see now the client's going to retire probably around age 65. You can see this guy's going to work till 70. So the earned income goes away then. And now he needs to start spending this money. You start to see the account values going down, and clearly we're not going to run out of money here. This client's in great shape, what we call position A. Enough after-tax cash flow to maintain his lifestyle adjusted for inflation, and he's got plenty of protection and assets here in the three tanks. So just a quick snapshot to answer your question, Mario.
Thank you.
Yeah, but let me back up to really what I think is important. Let me make this point, and I'll just stop sharing here for a second and jump back to Tyler's example.
All right. Table.
You were?
Table topper.
I'm trying to keep my hands down.
Not even way.
Yeah.
All right. So this is why we have this process, so that I can stay on track. I met with 6 clients already. I don't want to skip anything. So I make sure that I introduce the PEM to you. I want to answer those 4 questions. We'll do that with the portal that you fill out, the questionnaire, and then I'll have the data to be able to do that analysis and test the model and make sure that we're making solid recommendations for you. But first, what I want to do, if I could just take another maybe 5 minutes to just walk through, again, elaborate again on what makes us unique and different. With my practice, you have this circle of wealth. You have your money that exists. And, I work with clients. Obviously, some people have more money and some people have less money than you, Tyler. But what all my clients have in common is that they all want their assets to grow. And what I look at when I talk to my clients is really, they have 3 types of money. It's not just one big pool of resources. What I look at is the accumulated money. That's, again, what most advisors focus on first is, hey, what do you have? We could do better with it. Higher rates of return, better products, lower cost. But it's important to recognize you have your lifestyle money. Now, I know you're a responsible individual and you're managing your budget. I'm guessing you probably don't want me to spend much time in this area, because a lot of advisors will tell you, in order to reach your goals, you need to reduce your spending and put more money over here.
Yeah, Tyler.
Right.
Reduce your spending.
That's not our expertise. Our expertise is finding those transfer dollars and moving that money over here. If anything, I'd like to see we move some over here and we also increase your lifestyle. Maybe we put some of these transfer dollars over here along the way, because, hey, you only go around this lifetime once and you may as well enjoy it, right? And so we want to make sure we're maximizing your lifestyle and not reducing it. Okay. So I think that's another area that makes us a little bit different.
I might have missed it. What did you say? What's the transferred money? What is that?
Yeah. So these are things like, great question. Well, there's 5 main areas that that most people have these wealth transfers occurring. We look at about 32 different areas very closely to find out where these wealth transfers are occurring. But the big ones are taxes, your mortgage, how you're paying for your kids' college, how you're making large capital purchases, and how you're saving for retirement. Okay, so those are the 5 main ones. But what I want to point out, again, as a fiduciary, not only are we going to calculate that wealth transfer, but are you familiar with this term, opportunity cost?
No, I mean,
Okay.
I feel like I've heard it, but I don't know. Yeah.
Yeah, I mean, it's just an important feature that I want to point out, because for every dollar that you transfer away, you also lose the ability to earn interest on that money. So that money is gone, and the opportunity cost is the money that you could have earned on those saved resources. And so we'll calculate both of these things for you to show you the impact that we can have on your retirement savings over a lifetime. I'll say it right now. When I work with a high net worth individual, or, even average salary clients, we could over time, and I don't think I'm overstating this, I'll show you a lot of examples where we can find between $3 and $5 million that would have been transferred away. You would have had this lost opportunity cost, and we can actually improve your overall financial picture in that range. I mean, if it's a higher net worth client, it might be over $5 million. But that's a typical example of the impact that we can make over a 20 or 30 year time frame, which I know we have. You're a young guy. So,
and you mean that because what, they're spending more on interest and paying the bank that interest versus earning the interest themselves? Is that the kind of opportunity cost you're referring to? What kind of?
Yes, that's one.
Can you,
yep.
What's
absolutely.
another one, maybe, just to kind of give a real world example?
Yeah. So, Tyler asked me about what's that red sleeve on the risk tape there. And so let me go into that. When you talk about your qualified plan, I touched on it earlier. So these are these 5 areas, but let's go and give you a real good example on the qualified plan. It really does 2 things. These guys in the break room, they say, hey, we'll set you up with a tax deferred strategy. Really, that's a smart way of saying postpone. These geniuses at the IRS, whoever came up with that, it was a good strategy. But it's really more accurate to use the word postpone. And I don't know if you've ever postponed a toothache. It's not usually a good thing to just postpone something, especially when it comes to taxes. Because here's why I say that. What tax bracket will you be in at retirement? Do you know? Exactly. No one knows. What deductions will you have when you take out the money? Let's talk about tax history, because I don't know what you think about taxes. You think they're going up or down in the future? Most of my clients and prospects agree with you, Tyler. Yeah. Officer Ty, over the last 100 years, the average tax rate in the U.S. is 56.58%. This is where we are today. The highest tax bracket is right here. Okay. What I want to point out to you is that when people will say to me that they have, I'll just use an example of $100,000 in their retirement account at work, for example, their pre-tax savings retirement account, I unfortunately always have to point this out to them. And to answer your question, what's that red line? Well, that represents the IRS's share of what's in that investment. That's what they consider their money. And remember, everything that comes out of that tank goes through that tax filter first before you get it. So they're going to get that $37,000. So you actually only have $63,000 in that account. Now, if tax rates should go up in the future, you can see quickly what can happen to somebody's retirement savings on distribution. And for you, I mean, you might not be taking this money out for 10 years. So it's really important to focus on this and how we can reduce this risk and help you manage this risk. because there's a lot of things happening. I don't know if you've ever seen the U.S. debt clock, but I'd like to show you that real quick. Okay. I'm going to share that with you here.
Yeah, you really don't want to see it.
I don't want to see this.
No, this is alarming.
Oh, yeah. So here, I have to go back and change my screen. Hold on one second.
And then just to clarify in the graph, so the red, that's the years on the bottom, but that's the average salaries and then the line that you were showing across, that's the tax, what the average tax is.
Well, that's your tax rate currently.
Those are tax rates. The
That's what
red
that
bars.
Red bars
is
are tax
representing.
rates. Okay.
Tax rates.
Okay,
So that's just
gotcha.
showing how much they fluctuate.
Oh,
This is
okay.
what nobody, the financial advisors just out there typically want to focus on. Hey, let's just earn more money.
Gotcha. Okay.
Right? Let's ignore the elephant in the room, which is taxes.
Yeah.
Hence
Right.
the name of the show,
reason-
Seed or Harvest. You want to pay taxes on the seed or the harvest?
Yeah.
Right?
You see the U.S. debt clock now?
We do. It's hard for us to see, but
Yes.
yes,
Fine. That's probably a good thing.
you don't want to see it. It's in red, just in case that red number, that's not a positive.
No, it's not positive.
Yeah, this $35 trillion in national debt is $106,000 in debt per citizen. The debt per taxpayer is over $250,000. You're a taxpayer. In fact, you're a taxpayer that makes good money and has a bunch of money in these qualified plans that, as I just mentioned, the government controls the tax on the distribution. So I'm just going to jump back to show you the model real quick here. I know I'm jumping around, but this is the advantage to doing it, to showing you this, because when we look at the model,
Isn't that amazing? Over time, the average is 56%.
This is crazy.
World wars, man. That's all it takes.
What's that?
World wars.
Oh, yeah.
It's World War One,
Is that
World
where
War
the
Two.
spike-
That's
the
where all the
spike was?
spikes.
Yeah.
yeah, and I know we're probably spending a lot of time on this, but let me just make sure I show you this. So, yeah, great point, Mario. What was going on here? Well, when they started the IRS, World War I, they had to raise taxes. They had to pay for it, right? And then here, this is the stock market crash. Taxes got low again, and then they raised taxes. The Great Depression. They with these tax rates, very, very high tax rates in the United States. JFK came into office, and tax rates did start to come down. And so Reagan really started lowering tax rates in the 80s. And if you look, they've been relatively low since then. And we have, the Trump tax cuts back in 2017 that are set to expire at the end of 2025. So if Congress does nothing, we'll automatically get a tax increase when they revert back to the previous tax brackets. Now, we know Congress is good at doing nothing.
And Todd, if you don't mind me, I'm just going to elaborate a little bit more on that. That graph you're looking at was the highest tax bracket. That was the levels that we're adjusting for when you're in the highest tax brackets.
Okay.
So it's that the tax, understanding the tax brackets and what portion of your income is taxed at what rate is something people really lose sight of. They don't understand. And Todd, at what part of your income can you recall offhand? At what part of your income as all of a sudden can be taxed at the highest tax rate? Is it 84,000?
Yeah.
What's that number? Do you recall?
I'm gonna show you that number because I have a great illustration.
So here. As people work, people that are underneath the income level, if you're only making $50,000 a year, you're not going to see that percentage of your income. It's that proportion of your income that's over that puts you into that highest tax bracket that's taxed at that rate.
Gotcha. Okay.
There you go. It's $731,000. That's the highest threshold at 35%. If you earn over $731,000, you're paying the 37% tax level. You see how this works? So in the United States, the way the tax code works is you have a standard deduction. If you're filing jointly, you get a $29,200 standard deduction. It means no tax on the first 30 grand that you earn. Everything over that, from up to the next $23,200, is taxed at the lowest tax bracket level, 10%. And you could see, to maximize that, you pay your $2,300 in tax there. Then everything over $23,000 is at the 12% bracket. here are the two that are set to go away. The 22 and 24 are going to expire unless Congress acts and then President changes that law and it extends the tax cuts. Those 22 and 24% bracket are going to go back to 25. So there's the automatic tax increase on all these dollars. And you could see if you're earning $250,000 a year, that's about $30,000 that you're paying at these lower levels below 25%. If you're earning more than that, let's say you're earning, 700, then you could see what happens. Then you start to maximize the 24%, the 32%, you pay $33,000 and inside that bracket, and then 35%, you're paying $64,000 at that highest level.
And what's really alarming when you start understanding what Todd is showing is that depending on when you take out your money, at what age, and if you're pulling it out of a tax-deferred bucket, well, it only takes one flip of a switch by the next incumbent, the next president or whoever's coming in to say, hey, I'm going to alter the tax brackets or the tax rates for that bracket. They pull two levers.
Yeah.
Every president. Are they adjusting tax brackets or are they adjusting tax rates? And so no one can predict that. So it's interesting that if you saw even on the last example, the gentleman had a ton of money in his tax deferred bucket, very little money in his safe bucket. So to me, it's a big concern for people out there that they're just overlooking, and most financial advisors who do not like life insurance because they want to manage your money. Reality is life insurance is one of the few products out there other than Roth IRA that you can pull out in a tax advantage situation. So when you are pulling money out of that, it's not stacking on top of your taxable income because you saw those tax brackets.
Yeah.
So your pension starts right there, and then if you have any Social Security money, that's there. And then it just comes out of all your 401ks, and so people don't talk about that. They don't.
Yeah. Let me just add to that point, Mario. It's a great thing that you're mentioning is, what is the next Congress going to do? Well, just since I've been in the business, look at all the changes to the tax code. These are the government tax acts that have passed, in 2005. A lot of these are good, but, some of them may be questionable. And so when you look at how often, this is why we have a tax code in our country that's this thick, because even just in the last 10 years, I'm going to, probably scroll about 3 pages of different tax acts, including some very significant ones in the last 3 years, going back to the Secure 2.0 Act and how this affects your qualified plans. Because not only do you have to worry about you getting taxed on that money, but your beneficiaries. If you should pass that money on, it is not an efficient wealth transfer vehicle. Under this new Secure 2.0 Act, your beneficiaries, whoever inherits that money, they're going to have to spend all that money within 10 years. And so imagine that. Imagine increased taxes on maybe your children who are in their working years that are suddenly having to pay additional taxes on these resources that either mom or dad worked so hard for over their lifetime.
And that money that they're then taxed on, that's not considered. Is that considered it's not an income tax though, right? Because that's not stacking on top of their income, is it?
It is. It would be ordinary income.
So if if your kid is making a couple $100,000 that year, they're doing well, and then all of a sudden they have this transfer come in. Well, now all of a sudden that bumps them into a
different tax bracket,
potentially different tax bracket, or they're forced to take out money at that time. This is what's dangerous about what our government has put all these incentives in place for that people really don't talk about. Everybody's just like, let's outgrow it.
Yeah.
So sorry, Todd, to interrupt. I know you got a flow, buddy. I'm just kind of interjecting as
you're taking me down a path I would like to talk a little bit more about if we have time.
Yeah, we're doing good.
Yeah. So, let me just talk about this government thing again, because, the government and, your guy at work is encouraging you, hey, put money into the 401k or the 457, do these things, do these pre-tax plans. Well, a lot of times you kind of have to, in my business, think about, well, why is that happening? I was part of that. I encourage people, as I said, for many years, start saving. And I think it's a great thing, especially if you're getting a match in the company plan. If you're getting a match, why would you leave free money on the table? Absolutely take advantage of that match. And so, we're either going to learn how to become the bank, or you're going to just be a customer of the bank. You're going to finance, your mortgage and have credit cards and take out a car loan. And, there's really nobody teaching you or clients or anybody, even in the education system that we have today, how money works. And so that's my job, is to make sure that you know the rules to this game. It's just like this game of tic-tac-toe. I like to show people, when you started out, whoever taught you the game certainly didn't teach you the rules. You kind of had to figure it out as you go. And you probably lost a bunch of times. Well, it's the same way with money. You're figuring this out as you go. You could lose hundreds of thousands of dollars over time before you figure out these rules. And so my job, again, as a fiduciary, is to make sure that my clients know these rules. Just like with tic-tac-toe, if you know the rules to the game, you should not be losing. There is no way you should have these unnecessary losses. And so again, if you're just focused on this, I like this golf analogy here, just because I'm going to pick on Mario for a second, since he started with me at the beginning of this conversation. I've been waiting for this all day. If you're just focused on this bucket, if we had never met today, over time, that's going to grow. But you're probably just going to be increasing the risk that you're taking. If you're trying to increase your rate of return, it requires that you take risk. But if you're not working with a fiduciary or someone like me, all these other areas are likely to be increasing as well. And so just like with the golf analogy, before we put a new set of clubs in your hand and go out on the first tee box, I want to take my clients and prospects to the range and get their swing down and make sure they have a good swing so that we're hitting it in the fairway before we go out and find a custom set of clubs for them. Because when we look at investment companies and banks, what they offer the consumer are products. And well, let's face it, if you're going to play golf, you need clubs. I'll concede that. But getting to my Mario analogy is, if I just buy Mario a new driver, I've played golf with Mario before, and I give him the best driver I can buy, he's just going to hit it further out of bounds. Okay? I got to take him to the range.
I know that's
first.
right. Yeah.
I got to make sure he's got that swing dialed in, and then I can get him a custom club that's really designed for, that slice that he's got. So it'll help him out. So that's what we do. If we're not looking at these other areas, we're just going to have this problem over time. And so that's my area of focus. If that's okay with you, I'd like to start with this transferred money area, and we can show you, we can help you save money too. I think that's a great thing. I'm not saying that reducing expenses is bad. If I just want to show you a quick example, if you're making $100,000 and you're saving $6,000 a year, well, the return, if you're earning 6% on the interest of that savings, is $360. But when you look at your expenses, the rest of that money that you are spending, let's just say you reduced that by 1%. If I do that math, that saves you $960 compared to this $360. That's a 16% equivalent rate of return. And that's why, again, I think it's so important to focus on those wealth transfers, because fees are one. That's one that I consider a wealth transfer. If we can reduce fees by 1%, or your other expenses, or an unnecessary wealth transfer, we can make a equally, or if not more, of an impact, a bigger impact on your overall plan. And so I just want to give you that quick example before we move down to just this last slide, and then I'll get back to the model, because I like to end there. Let's plug these holes, Officer Ty. Let's make sure we're not losing money here. And even a trickle going into this thing, even if you're not maxing it out. You said at the beginning, you felt bad, like you did something wrong. I don't think so. I think, you got started. Even a trickle will fill these buckets up if we're not losing money through a bad tax strategy. And that's my concern here. If we just only focus on one or two areas that we're overlooking, a a bigger value add that I can offer you and all my clients. So on a scale of 1 to 10, I always have this little thing here to remind me to ask you, how does this sound like? Is there anything I'm missing? Is this what you're looking for? Or is there something that I didn't talk about today that you wanted me to address?
I mean, I can't think of anything else I'd want you to address, but yeah, to say like scale wise, yeah, 100%. It's what I'm looking for. Like I'm, maximizing and being able to make my money go as far as I can when when I do leave, I want to experience things and I want to have the money to do that. So.
Well, and if I've learned anything about you so far, I know that nutrition is big in your world, in your life. And I know you really try to be most efficient with the calories you're ingesting and proteins you're ingesting and everything else, and try to cut the fat out, or the bad elements that affect your life. And it's really interesting how we'll take that approach a lot of times with fitness and just nutrition, but we really don't take that same approach that you're recommending here, Todd, that you're bringing up on being inefficient with our dollars.
Yeah.
And we're not even looking at it. We're not researching about it. It's just such a complex subject matter. And that's why I'm really looking forward to having more of these conversations. I really love your model here, Todd, so that you can kind of simplify things, bring in real life examples to dum-dums like me and myself. I'm not going to call you a dum-dum, Officer Ty, but I'll refer to myself. This is
with this I am, yes. So
it's I'm around it a lot, and I still always learn more. So this is really cool.
Again, I don't see our education system providing this information to our youth, and I know even as a financial advisor, nobody was teaching us this. Took a team of financial advisors working together to build this model. We've been developing this for decades, over 25 years, building a way to be able to communicate all of these financial concepts and ideas with a picture. And I think that's what's so powerful is, we can show you, easily this tax risk, easily, where the investment risk is. Any question that you may have, I'm likely to say, I don't know, let me test it in the model. And then we can put the numbers in, we can test it, see the result, and then I can really come back with a quantitative answer for you and say, here's the best result. This helped us in these ways, and show you very specifically the improvements that we can make. So I think this model is really key to being able to communicate with people and educate people, because again, it's not out there. And we've developed, we have curriculum now that's being taught in universities across the country. I teach elementary school, middle school, high school kids, talk to individual college kids about this. I mentor kids that we provide scholarships to. So there's a lot of ways that we use this model to educate people. So it's not just you, Mario, believe me. I talk to high net worth individuals that are in their 60s and 70s and 80s that still are, practicing philosophies that maybe they learned when they were kids, maybe from their parents, from, the Depression era. Hey, I don't want to ever have debt. Well, hey, everyone has debt. That's called a mortgage. There's a lot of ways to use other people's money. There's a lot of modern, more progressive philosophies that we can now help our clients with to really solve what the biggest problem is today. People are outliving their money. To your point, you got a guy as healthy as Tyler, the picture of health. He's careful about everything he puts in his body. He takes care of himself. I mean, chances are you're going to live a lot longer than the previous generation, especially if you have resources, you have assets to get good medical care and good health care. So, we as financial advisors, and being in this business as long as I have, I've had the pleasure of seeing people go through all phases of retirement, from just getting started to my grandmother lived to be 98. My aunt was 101, seeing the full spectrum of the process took a while to go through for me, but having been through it with so many clients now, it really makes me an expert in being able to spot these things for a young guy like you and educate you. So now you feel empowered. You know, I
Well, and
call
it's so
this
critical.
the,
Well, I'm sorry to cut you off
yeah.
here, Todd, but we're just
Yeah,
kind of
no,
running
please
through
do.
here. Running through time. It's
Sure.
again, this model is just unbelievably powerful, and the way to turn something visually almost to a tangible thing, of something that's just an intangible poof out there. I've got this 401k money. How does that really work with all the other things? At the end of the day, that's what you do, and that's what's really impressive with this model. And I hate to cut you off, but we are getting pretty lengthy here. We're getting pretty deep into it. So.
Yeah, well, so we'll follow up next time. I'll go through the questionnaire with you, Tyler, and we can go, through the steps 6 through 10 next time we get together. And it was a real pleasure meeting you, Officer Ty. Thanks for taking the time today.
First of many conversations that we're going to have, and we're going to peel back a lot of different topics and subject matters. We are looking for topics and ideas to discuss. Please don't hesitate to leave in the chat. Send us a message, something you'd like to see. As Todd has mentioned, he can customize any scenario for the most part. And so anytime you want to see like a comparative analysis, should I take money out in a HELOC, or should I do something else? There's a lot of different scenarios that you have access to that people just don't know what to do. So a lot of times people take the path of least resistance. Or maybe having assets in a liquid bucket. They don't, and they want to pay off their mortgage, and they don't realize that all their cash is tied up in an illiquid asset like their home, and all of a sudden they have an emergency in their life, and all of a sudden they need to tap into the equity in their home. But guess what? They go to the bank, they don't have income coming in to support the mortgage, and then all of a sudden they're forced into higher interest buckets. And this is what I love about working the models that this Circle of Wealth tool and Todd specifically helps people understand. It's not all about growth. It's about limiting that opportunity cost of wealth transfer. And thank you, Todd, for jumping in on this. I'm really excited to have these conversations moving forward.
No, it's an honor to work with a law enforcement professional. I always have this phrase that's top of mind when I work with all my clients, but it's especially, I think, relevant for somebody like you. And it's the luck factor. First of all the risk you take at your job, you must have a little luck on your side, I would imagine, to, survive what you do every day. There's trouble and you're going toward it. And so the luck factor that we consider for you is the liquidity, that's the L, use, the U, and control is the C. And I would say the K is simply the knowledge. Now that you have that knowledge, as we all know, knowledge is power. You can make those decisions. And it makes our future meetings a lot easier because now you understand our philosophy and the system and how money works. And it makes these future conversations a lot easier. And, feel free to bring your spouse into the meeting because
we'll definitely be doing that.
You may try to convey this to her and forget half the things that I said. So I'm happy to meet with your spouse too, and or any of your colleagues, anybody that you want me to talk to. That's happy to do it. That's what I do.
Outstanding. All right. Well, Todd and Officer Ty, thank you for your time today.
Thanks, Mario.
All righty. And let's
thank you, Officer Ty.
Yeah, thank you.
Call's a wrap, and we'll talk soon. Thank you.
Great. Thanks. Bye now.
All right. Well, thank you for watching another edition of Cedar Harvest. This is our law enforcement edition. We're going to be working with many other law enforcement officers. We are looking for you. If you are interested in coming on the show and asking questions to the variety of professionals that we will be working with, lawyers, financial advisors, all sorts of people, pension experts, we're bringing them on to help you understand what's best for you and your family.